Hello, this is Paul Orchowski with MGO. I'm here today with Scott Lipa, our Senior Investment Analyst, and Michael Moskal, our Director of Investments. Wanted to give you a brief market update and kind of see, give you a little indication of what we see in the market here going through this bear market and this whole COVID-19 crisis. And we're going to turn it over to Michael to begin our presentation.
Thanks, Paul. Before we start on the actual presentation, I wanted to share with everybody, I've been keeping a list of words that I'm hearing that are sort of the more common words being spoken about this whole coronavirus, and the whole crisis that's happening. I'm hearing these from investors, from clients, from friends of mine. I'll just share a few words with you. Scary, concerned, worried, opportunity, overblown, patience. Those are just a few. And I think the word I probably hear the most from the media, especially, is the word unprecedented. And certainly we are going through an unprecedented time period in our country, at least for our generation. We've not seen something like this before. But I think there is reason for optimism for the future here. And, we as a country, if you go back long enough, we've been through a lot in this country as far as crises are concerned. We're talking about world wars, civil wars, depressions, Great Depressions. We're talking about even attacks on our country, the terrorist attacks that happen. And if you look at each one of those, when the crisis, you got to get through it. We've gotten through those. But you get through the crisis, and we come out on the other side. Each time we've come out on the other side, a better and more prosperous country. So, Paul, I think I would say that MGO's philosophy on this is that I don't think there's any reason why this wouldn't happen again that way. We see no reason why this would be different this time. So, for us to be patient, get through this, and we think there's better times ahead. All right, well, let's dive right in. And, Scott, you're going to jump in here too. Let's dive right in and go through some things here. All right, the elephant in the room. Obviously, the elephant in the room is the coronavirus and the effect that the coronavirus is having on the economy and the markets. This chart here is showing some pain here, as we all know, in the jobs market. After many, many years, 10 years actually of straight jobs growth, we are now on the opposite side with some very severe job losses here. And these are jobless claims or people filing for unemployment. The last couple of weeks, they're going to have another number coming out this week, which is probably going to be about the same as what we're seeing there, probably in the 6 million range. So, just to say it's not the end of the world, but we should just be prepared for some ugly numbers to happen here, in the next number of, if you want to call it weeks here that are coming up. More jobless claims. We'll talk about, GDP coming up here. But just to prepare all of us, we're going to expect to see some ugly numbers here. On the GDP front, GDP is gross domestic product, the rate at which the economy is growing or not. If you have negative, obviously you're not growing. So Goldman Sachs expects the economy to shrink by 24%. This was back in March, at the end of March. So the next quarter is actually this quarter, the second quarter of 2020, 2.5 times bigger than any other decline in history. Again, the reason I put this up here, just to prepare ourselves, we're going to be bombarded with news that's going to be about how bad this whole economy is. But as we'll talk later, we do expect this to be a shorter term event. The other pain we felt, of course, is in the investment markets. And this is first quarter performance. Stocks going down anywhere from 20 to 30%. Even investment grade bonds got hit. And the reasoning being, a couple reasons actually. One, there was quite a few liquidations going on with hedge funds in that first quarter. Hedge funds that have taken on a lot of risk. There was a lot of people who borrowed money to buy stocks, and they were getting margin calls. And in those days that we were seeing where the market was down so much, you had a lot of forced selling going on. So forced selling being in just about everything. Any kind of stocks, almost all bonds except for government. Oil on the bottom there, down 66%. That was another issue we had. Gold was another safe haven happening in the first quarter.
Michael, a couple comments on that. What what's really startling about these numbers isn't the numbers themselves, that you're down 20-25%. I think the interesting thing is how quickly it all happened. I mean, you're talking from market mid-February to the end of March, 37% off market highs. I mention it because it's one of those things where this isn't exclusive to just the US or exclusive to just Ohio or our portfolios for that matter. This is the entire world pulling back at the same time and pulling back very, very quickly. So everybody's in the same boat. And I think everyone being in that same boat, you know, as quickly as we've seen everything sell off, we could probably equally as quickly see things rebound pretty significantly when you mentioned the jobless claims, but when we do get back to work and when we do get back into the economy, trust in the U.S. consumer to go out and spend money. You know, I think it's going to be significant at some point when we do see a rebound, how quickly that happens, just like the sell-off took place.
Yeah, that's an excellent point, Scott. And, you know, a couple things with that. You know, you're absolutely right when you look at the world, because the world, we're about an $86 trillion economy if you add up everybody in the world and what they produce for economics. You know, the big three, of course, are us, U.S. You know, United States is about 22 trillion. You got Europe in there, if you add up the European Union, at about 18 trillion, and then China at 15 trillion. And, you know, you have all three of those that are pretty much shut down. So you're absolutely right. It's the whole world, you know, besides the other smaller countries in there, you know, and it's going to probably take all of us sort of together to get this going again, but it will. You know, we really do believe it will. One other point on this, on returns, is, you know, we have had a rebound in April, which is positive. You know, for the month of April, we're up about 5%. Certainly this last few days have been up much more than that. But if you look at the month of April, we're up about 5%. Also, our managed accounts, you know, for those individuals who are in our managed accounts where they're paying us to manage their money, you know, we did outperform these indexes that you see on here by anywhere from 3 to 7 percentage points, you know, for the year. So we think we've done at least a decent job in protecting some capital here. So, but yeah, we're waiting for, you know, we'll wait for the economies to be recovering, and we're looking forward to seeing some positive numbers. You know, one more thing on here, because Scott, we do, and Paul, we get the question. Of course, the most common question is, what do you think is going to happen, right? You know, what's going to happen next? And we're going to address a little bit of that in later here. But, you know, generally speaking, you know, we would expect the second quarter to be better as far as performance. Very rarely would you ever have back-to-back quarters where you have numbers you're posting like this. That's a very, very, very rare thing. We don't expect that to happen. So we don't necessarily think the market will be up 30% this quarter, but we don't expect it to be down 30% either. You know, market cycles do happen. You know, we've not seen one for a long time. Since 1956, we've had, including this one, this is the 11th bear market. You know, bear market is defined where stocks are dropping 20% from a peak level. You know, we've not seen it in 10 years. And, you know, usually they happen just about every 6 years, 5.8 years on here, with an average decline of 33.8%. And Scott, you had mentioned we're down from peak to trough in this one.
37% on this one.
Yeah, so 37% on this one. So we're kind of right in where the average is. And, but we just, you know, the shocking thing about it, besides the rapidity of the drop and how quickly it happened, you know, is that we just haven't seen it. You know, usually we have these every 6 years. We hadn't had one for 10 years. This one,
Michael, we talked about that at our seminar last month, that our seminar was on the day, I think, that the birth date of the bull market that had just recently ended. We had our seminar on the 11th birthday of the bull market that we just saw come to a close. So extremely long bull market. To say we were overdue for it, not that anyone could have anticipated what we're experiencing today, but at some point we were going to see recession. The cycle was going to happen. Maybe this just expedited the market cycle a little bit more quickly than anyone anticipated. Yeah,
and you know, we've been around for a while, all three of us. So this is the fourth bear market I've been through, ones like these. You know, I started after the 1987 stock market crash. You know, we went through, of course, the dot-com bubble that happened, and the you know, the downturn that happened after that. That was in 2000 to 2002. We all went through the last global financial crisis that happened with the housing market, when the housing market bubble burst. That was 2007 to 2009. And now we got this one. So they do happen. every now and then they happen. They're always for a different reason. They're always for a different reason. So the reasons are always different, but they do happen every now and again. So, investors out there, if we're going to be investing for the next number of years here, decade, 2 decades or more, we're going to see this again at some point in time in our careers. So we don't like to see it, but we do see it every now and again. The average duration, how long do bear markets last? Obviously excluding this one, because this one may or may not be done, we don't know. A little bit over a year, you got 14 months. The average time to get back to the highs is about a couple years. So again, excluding this one, because we don't know yet, but we'll see how we go here.
So Michael, that's an important point there, is that the average bear market being 14 months and then 25 months to recovery. When I'm talking to clients, or what I've been telling a lot of the people I talk to, is if you're relative to making any decisions now to buy or sell, think about your situation a year from now, 2 years from now, and that with reasonable certainty and with history on our side, you could say that we will be in a better position 12 months now, 18 months from now, or 24 than we are today, just based on past bear markets that we've seen.
Yeah, absolutely. And always the challenging part, of course, is the averages are the averages. And what this chart is showing, it's a little small, but all these lines are the last 10 bear markets that we've had. And you can see that there's some extremes when you see these lines going up and down. The dark blue lines are the length of the bear market in months. And then the light blue is the actual percentage decline. And then the light brown is how long it took to recover. So you see, sometimes you get really short bear markets, sometimes you get long ones. If we had to take a guess, we've talked about this, 1968, which would be, this one over here. If you're going from left to right, it'd be the 1, 2, 4th one. You had a 17-month bear market. You had about a 36% drop, and it took about 21 months to recover. So pretty close to the averages. So it sounds kind of like maybe we're in that kind of range, but that's not a promise, right? That's not a promise or guarantee. We'll have to see what happens. Another point, looking back, if you go back a long, long ways, this one's 105 years, this chart, but stocks have been the place to be over time. And over long periods of time, stocks have returned about 10% on an annualized basis, bonds close to 5.9%, and CPI, which is inflation, about 2%. So, over long periods of time, it has been better to be in stocks than anything else, as far as investments are concerned. Now, you've had to go through, and if you look at the chart, you see a lot of ups and downs in there, right? There's a lot of ups, a lot of downs in there, so you got to be able to accept some of the volatility or some of the ups and downs that happen. But over long periods, the place to be to get returns has been in the stock market. All right, what's ahead? What do we see happening here? What's ahead for the economy and the markets in the future? We would call it a get-through period, which we're in right now. And on this chart is from Morgan Stanley, so it's another Wall Street firm, and their prediction on what's going to happen with GDP or economic growth. The minus 3.4% that you see there, that is the first quarter of this year. That's their estimate. That's not come out yet as far as what that number is going to be. The government has not announced it yet. That big down that you see there, that's their estimate on what they think the second quarter, the quarter that we're in right now in the economy, what they think the economy is going to decline by. And that's what we meant through a get-through period. We know the drop's going to come, just a matter of how much the drop is going to be in the economy. But once you get through the get-through period, at least Morgan Stanley's estimates are, we're going to have a big snapback, like you mentioned before, Scott. Big snapback. They estimate the third quarter of this year, you have a 21% essentially increase in economic growth, and then a 16% in the fourth quarter, and then moderating into 2021. We'll see if that comes true. Again, these are estimates. We don't know whether that's going to come true. But we do know at some point, right, that people, once we're out of quarantine, we are going to all leave our houses probably. We are going to go to the restaurant and buy some food. We're going to go shopping. We're going to go maybe to sporting events. Go back down and see some football games or baseball games or something. And start spending some money again. So we will have some recovery. Not all of it, of course, will come back because people aren't going to go to the restaurant and eat 3 meals at one time. But we are going to see some pretty significant snapback.
Michael, what
And
do you
one thing
think
to,
of those numbers?
good.
Those the third and fourth quarter GDP estimates, the 20%, or the 20.7, the 15.9. In my mind, those seem a little bit conservative. And you know, not being unsensitive to people that are out of work right now, but thinking to myself, there's a lot of people that are working, that are receiving stimulus checks, that are sitting on stimulus check money, that are sitting on, I mean, prior to all of this, it's also tax return season. There's a lot of people, this is a big spending season for retail in general, just because of tax returns. The auto industry does well right now. Retail does well right now. None of that money is being spent right now. And my thought is that a lot of people are sitting on that money and with the intent of it's going to get deployed into the economy at some point. So when I look at those numbers, I almost feel like third and fourth quarter and then into 2021, they almost seem a little bit conservative to me.
Paul, did you have a comment?
My comment was separate from that. It's just more, I think you can answer this, but when you look at these numbers, you know, one of the things to remember, this is GDP. This is not what we're predicting, or Morgan Stanley's predicting is going to happen with the stock market. You know, the stock market's not expected to be down 37% this quarter. The stock market actually is a predictor, an advanced predictor usually of these numbers. You know, this is really just what the economy is expected to do in terms of growth. So anyway, you can go ahead and answer Scott's.
That was a good point, because yeah, these are not stock market numbers. These are for economic growth in this country, people working and doing things and providing services. I think behind these numbers, Scott, because you know, these are all guesses, of course, but I think behind these numbers, what the thought was is you may not have everybody jumping out of their homes all at one time, going and doing things. You know, there's still going to be maybe some people that are cautious, maybe not rushing out right away and going to restaurants. Some people may wait a while, like 9/11. The premise was sort of like 9/11. When we got past 9/11, not everyone went and jumped on planes. It took some people a year and a half to feel comfortable to go get on a plane again. So I think what they're doing is spreading out the recovery over more quarters. Remember, we've been growing look to the left side of the chart, we've been growing at 2% essentially, right? So some of the rebound that they have is spread out into 2021, where they're saying, look, it's going to be maybe twice what we've been used to doing in 2021, which is still more economic growth going on. So I think that was the premise behind here was, yeah, you may not have everybody rushing out at the same time going to do things, so you may not have an immediate snapback increase to the extent of what we went down that second quarter. It's more spread out over a period of time. You know, the second thing that's happening right now, you know, and here is, of course, you have a lot of, you got massive government money coming in. You know, the CARES Act was passed. It was $2.2 trillion, which has just started to get filtered into the economy, you know, to try to help things and help stem some of the losses that are going to happen with the economic, you know, the economy, and economic growth. So, but we all of us, I think, agree this is probably just the beginning. You know, the headlines here, Trump urges $2 trillion more. That's not the $2 trillion that they passed. You know, he wants $2 trillion in addition for infrastructure. And I think they have a lot of support in Congress to do that. You know, so you add that in there, that's $4.2 trillion. And I think, again, the three of us are probably in agreement that that's not going to be the end of it either. You know, there's probably going to be more in here. I don't know, guys, 6 trillion, 8 trillion, maybe
Michael,
more.
I've been telling clients that it wouldn't shock me if we got to 10 trillion. When it's all said and done and the final tab is in, 10 trillion would not surprise me in the least. The question I get from clients the most, though, is who's paying for all this? Who's writing the check for all this? And in the long run, who's going to pay for all this?
Yeah, so, you know, all you really, because, you know, when I'm watching CNBC, I'm yelling at the TV when they just talk about how great it is that there's all this stimulus going in there, all this money going in there. And that's true. In the short term, it is very helpful in the short term. I mean, there's no doubt about it. The money, you know, money is going to help. But yeah, absolutely. The money doesn't come for free. You know, essentially this money is being borrowed, which essentially means it's being printed. You know, so the Federal Reserve is authorizing the printing of this money. It's going to the Treasury, and the Treasury then is releasing it to whoever. It could be Congress, could be the Fed, could be somebody, but they're releasing it to go into the economy somewhere. So nobody really knows the outcome. We've never done this before. So, you know, will it result in high inflation down the road because you have much more money chasing the same amount of goods going on, you know, or even less goods because demand is less? You know, will that happen? Will deflation happen first? You know, Japan did this starting in the 1990s. So you're talking about 25 years ago, they haven't had inflation, they've had deflation. So I don't think people really know, as far as economists know, whatever it would be a guess, again, because it's never happened before. And so we do know it's not for free, okay? So there's going to be some payment down the road, whether, again, it's inflation, which eats away at money, the worth of money down the road, whether it's deflation, which eats away at demand and product, people buying things, so the honest answer, right, Scott, is that we don't know, but there could be a number of different passes that it could take, which we're going to get to in a couple of slides here.
So, Michael, we're talking about this being a bear market and how bear markets is a phase. There's phases too. We're in the bottoming phase of a market, of a bear market, right? And when you have a bottoming phase, you test the bottoms over and over again. But I've told clients this too, and the most dangerous words in investing are maybe this time it's different or this time it's different. But I've told people that the one wild card we don't know about, and we've never had a bear market with this unprecedented amount of stimulus. How long can or what can this stimulus do to stave off the worst of the worst as far as a bear market could look? And are they backstopping the stock market and the bond market by doing this?
Yeah, so there's two different things that are going on here, right? You got the government that is, the government is the beneficiary of some of this printed money. That money is going out to the general economy. It's going out to people, working people or people that used to work. That's where that 2.2 trillion and the infrastructure would be going to people. And the thought would, of course, be that people would spend that money, that they would spend it into the economy. So it wouldn't be necessarily going into the stock market. Now you got the whole other side of it, which is more opaque. It's more clouded. You don't see it that much. And that's what the Federal Reserve is doing. The Federal Reserve being the central bank in this country, the national bank essentially of the United States. And they're also funneling a lot of money, but they're not funneling it into the general economy. Their money that they funnel into is going into the financial world, the banks, asset markets, bond markets, that's where that money is going. So yeah, that could be, will the Federal Reserve at some point buy stocks? Could they jump in there? And again, they've not done it before, but if they did that and they said they're going to buy trillions of dollars of the S&P 500, the stock market, I guess that would push stocks up at least temporarily. So yeah, there are some things happening here we do have to watch and say, is it kind of breaking the cycle up or is it not breaking the cycle up? So that's something we do need to keep our eyes on. All right, this number 3 on here, it's a little bit of a longer term view. Structural changes are not things that would happen right now. They're things that would happen over a number of years, even decades. The first one being deglobalization, which is the opposite of globalization. Really since the wall fell in the late 80s, if you guys remember, Ronald Reagan saying, "Mr. Gorbachev, tear down that wall," in East Berlin. When the Soviet Union kind of fell apart back in the mid to late 80s, and all of a sudden you had a whole sector of economies that were going on that we could actually tap for labor, for products. So what you've had going on really in the last 30 years, and China also came about at that time too, you had a situation where labor costs were moving around the whole world instead of inside countries. We outsourced a lot, for good or bad. We outsourced a lot of labor costs to outside this country. We don't have a whole lot of things made here anymore. The manufacturing sector in this country only makes up 11% of our economy. So a lot of things were outsourced, which I put in here. Insourcing may be something that comes back, because I think a lesson that has been learned now, or is being learned now, is that when supply chains break, so if you're a company that had something made in China that then went to South Korea, that then went to another country, and it was 5 different supply chains before it came back here, and all of a sudden those are broken, you can't get your product. So the likelihood is over a period of time we're going to have more insourcing happen. We're having a little bit of, and by closing borders, I don't mean they're shutting and building walls at the border so no one can get in or out. It's just a more closing of borders where there's going to be a little bit more protectionism going on. So we're going to be favoring American companies here in America. And what that does, a couple things, by the way. For the stock market, it favors small to mid-sized stocks. Why? Because they're the ones who have the least exposure to foreign countries. Scott, what's for large companies like the S&P 500, what's their foreign exposure as far as revenue goes, their sales, profits?
Oh
What
my
percentage
God.
makes up?
It's got to be more than 50%. I don't know off the top of my head, but
Yeah,
it's a
yeah.
lot. I mean, it's a lot. They're global companies. A lot of them aren't even, I mean, yeah, this, what you're talking about is the smaller and the mid-sized, the regional companies, regional banks, that sort of thing that aren't as impacted. There are a lot of the clients that we work with that aren't necessarily as impacted by what's going on internationally as they are by what's going on here.
Yeah, so if you deglobalize, you're going to be hurting sales that are coming in from foreign countries, so, or profits that are coming in from foreign countries. So, usually when you have a deglobalization going on, it does favor your companies that just are not exposed there. And your number, I think, is right, by the way. It's about 50%, depending on if you're looking sales or profits, it's around that number. Another thing that could happen is more savings and less debt for consumers. What we're hearing now from a lot of people is, they're a little bit, again, using some of those words I expressed at the beginning, scared. Actually, somebody said, I didn't put terrified in there, but I did have somebody say terrified. But, people, when they get scared, they tend to hoard cash. And we're seeing that. And, those are usually trends that happen for a while. So if we do see some of that happening, where consumers are going to sort of scale back a little bit and take on less debt, that does mean less spending, by the way. That does kind of take away from economic growth a little bit. But in stock market terms, it favors those companies who have strong balance sheets. Balance sheets meaning they don't have a lot of debt. They have very strong cash positions. So in today's stock market world, you're talking about industries like the technology industry. Look at companies like Apple and Microsoft, Amazon. Those are companies that have a lot of cash, and they have very strong balance sheets. They're not really levered up with debt.
Well, additionally, Michael, on the tech comment, I mean, I thought tech, for the last few years, I've thought tech is one of the more overvalued sectors of the market. But when you look at how we're communicating while we're all staying at home, and the Zoom medias and the technology companies that that decentralize an office, I mean, those are going to be extremely valuable companies going forward. And then I mean, Amazon is here every day. Grubhub was here earlier today. I mean, these are Uber Eats. I mean, they're all companies, they're all technology type companies that are going to really benefit. There's going to be a lot of companies that come out of this on the other side, a lot more beneficial as we change the way we do things in life in general.
Yeah, that's a great point, because we are going to change. Not everything. Again, not everyone's going to stay in their house all the time. But there may be some movements, like people working out of their house a little bit more than maybe they used to. People willing to do things online a little bit more. Like my dad. So my dad's 83 years old, and he's learning to get online and order things. Because he really didn't have to do that before, because he's jump in his car and go to stores. I talked to him yesterday. He goes, "There's no restaurants open. I can't even get food." I said, "We got to order it. You got to call the restaurant. They'll deliver it to you." So those are kind of habits that do change from things like this. Other companies, by the way, besides technology, even companies like Walmart. Walmart, which does, and Scott, I think you had said your wife, right, Joy, orders food from Walmart, right? She gets the pickup.
Oh yeah. I mean, the super Walmart. We pick up groceries from there. I mean, I was at Target yesterday. Same thing. All I had to do was pull out, and a guy came out with my cart, threw everything in the trunk. I mean, we didn't. You wouldn't need to touch a store right now, and I think it's going to change the way people shop in general.
Yeah. So even companies like Walmart, those are companies we're looking at, because again, they have a very strong balance sheet. They seem very well prepped and primed for this next phase, sort of in this next cycle. So just a couple of companies, Coca-Cola is another one. Again, looking for companies that can deliver product to consumers and to people without having to have people touch them. The other thing we mentioned was deflation. Deflation is a sort of a trend where prices go down. And so when we say deflation first, why would that be? Well, because right now, at least, you have people that are pulling back and not spending money. So if people are not spending money, it has a deflationary effect on prices of things. Then we talked about inflation, down the road. If there's a lot more money in people's hands down the road and the same amount of goods, it's basic economics 101. The more demand for the supply is going to push prices up, or should push prices up. So that's our anticipation down there. These are structural changes looking out at the next decade or so. Financial repression, and that's a term that hasn't been used in a long time, but in the 1940s, you had the government, because of the war. You know, the war was a similar kind of thing, World War II, where they printed a lot of money, but they didn't want interest rates to go up. Why? Because it would make the debt more expensive, you know, for the government to pay it back. So what they did is they kept interest rates down very low, but they let inflation run. And if you do that, you make the debt cheaper when you pay it back. So we could have a situation like that over the next decade, you know, where the Fed keeps rates down, and yet they let inflation sort of run, because it makes the paying back of debt cheaper. You're paying it back in cheaper dollars. So that could be something that happens too. And what does that favor? You know, if you have situations like inflation happening and financial repression, it does actually favor stocks. You know, stocks actually do well in inflationary environments. But other investments like precious metals, and I threw in Bitcoin. Who knows if Bitcoin will even be around, Paul? You know, but currency alternatives, because you would think in a high inflationary environment, and by high, I don't mean 20% inflation. I'm talking about single digits. But remember, we've been used to inflation running at 1%, 1.5%, 0.5%. You know, so, you know, if we get 6, 7, 8% inflation, that is high. You know, that is high. You know, so if that happens, you would figure their dollar would be devalued, the currency, and it may push up things like Bitcoin or currency alternatives, if Bitcoin's still around, or whatever the currency alternative may be. You know, certainly precious metal. All right, what should you do? As investors, what do you do? You know, what do you do? So those who have a longer time horizon, which would include younger investors in their 20s, 30s, early 40s even, that have a whole cycle to go through here, you know, you want to stick with your longer term plan. You know, and everybody should have a longer term plan set up, where there's sort of a longer term situation they look at and say, here's the kind of risk I can tolerate for my longer term plan. You know, the emphasis would be on broad equities. What does that mean? Small caps, mid caps, even some large caps in there. You know, with an emphasis on small mid cap equity, smaller bond positions for younger people, and up to a 10% allocation to inflation hedges. Again, commodities, agriculture, precious metals. You know, those would be your typical inflation hedges.
You know, Michael, I've been telling younger people that I've talked to that this is an opportunity that I didn't think they'd ever see or I'd see again in my lifetime. And it's a quick story, but my daughter was born in April of 2009. And the market bottom was obviously March of 2009. She was actually born today. Today's her birthday. But in April of 2009, the week she was born, or as soon as I had a social security number, first thing I did was put some money in her college account. And I didn't realize it at the time, but what an opportunity that was for her when you see that college account today, just based on the timing of the investment and the fact that we're back to, well, we were when we were down 37%, but back to 2016 prices. For younger people, the opportunity is there. And if you have the intestinal fortitude to do it now, I mean, there really isn't a better time, buying time, whether it's, and you do it slowly. Obviously, we've talked about dollar cost averaging and the fact that we're not trying to call a market bottom or predict when this market bottoms or what happens from the next 12 months. But the opportunity overall, if you dollar cost average in today, you'll look back a few years from now and with reasonable certainty say, that was the time or lament that was the time you should have bought or you did buy.
Yeah, that's a great point, because, you know, all the greatest investors, you know, Warren Buffett, you can go through all these people over long periods of time. John Templeton back in the day, you know, they all said the similar kind of things. You know, buy when there's blood in the streets. You know, buy when other people are despondent. Buy when the mass people are selling. It's always those kind of things. So absolutely, Scott. You know, there's no doubt that this is like a generational buying opportunity, whether it's now or a year from now or 6 months from now or 3 months from now, somewhere in here. You know, when you have these bear markets, the bear markets are usually great opportunities to be able to invest. You know, how about those investors that are not in that situation necessarily? You know, mid to late 40s isn't necessarily old, okay, but it's sort of bordering on that line where you have a whole nother cycle to go through.
I'm in my mid 40s. I'm not old.
Well, I know you're going to say that. So you are, though. All right, still. All right, so you stick with the longer term plan. Again, everybody should have a longer term plan, but you may want to have a little bit more of a balanced approach, so you don't pile all your money into equities, into stocks. And you may emphasize a little bit more into dividend paying stocks, you know, a little bit more large cap in there, you know, the dividend payers. And you want to keep your bond position very high quality. And I don't have this in here, but, you know, probably shorter duration, you know, shorter term bonds. And then, even for people like this, to take advantage of perhaps an inflationary move that may happen, having a 10%, at least a 10%, maybe that's a minimum, and maybe even something a little bit higher than 10% allocation to, again, commodities or agriculture, precious metals, something like that, again, for an inflation hedge. So that's really it, Paul. That's really our talk today and our advice to people that are watching this.
That was very helpful, guys. Any last parting things you want to share before we wrap it up here?
No, just the fact that we are going to get through it as a country. We've gone through a lot of things in the past that we always get through, and this will be another one I think we'll get through, and we'll come out better and more prosperous at the end.
And like I've been telling people for the last couple of weeks, if your goals haven't changed, if your outlook on 3 years or 5 years from now or retirement hasn't changed, this is not the time to be trying to time a market or play with your accounts. This is a time where you just, you skip a couple months opening the statements, knowing that 12 months from now, 24 months from now, we will be in a better place than we are today.
Okay, great, guys. We appreciate everyone that was able to join us on this and be able to view this, and hopefully we'll bring you some more editions of our market updates as we go forward and more things happen and we progress through this crisis. But we wish you all well, and we'll be back to you hopefully soon. Take care.